You are listening to Keystone Stock Talk Podcast, episode 151. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, coming off a quick vacation and some overnight Olympic viewings, I am itching to get back at it. We have two Your Stock Our Take segments for you this week. The first is on WELL Health Technologies Corp, symbol WELL on the TSX, an omnichannel digital health company focused on empowering doctors to provide the best and most advanced care possible while leveraging the latest trends in digital health. WELL has been highly acquisitive and recently closed another significant acquisition. A listener asks us if the recent pullback is an opportunity. Our second Your Stock Our Take came in from a listener on Tree Island Steel, symbol TSL on the TSX, which operates in the steel business and is primarily engaged in the manufacturing and sale of steel wire and related products for a diverse range of industrial, residential construction, commercial construction, and agricultural applications. Tree Island is lightly traded microcap, which has shown life again in 2021 after a decade of moving sideways to down. A listener asks us our take on this little followed company. Finally, our dog of the week is a once high-flying but highly speculative microcap, which we have warned listeners against purchasing on at least two previous shows. Sona Nanotech Inc. is the company's name, symbol SONA on the CSE. After briefly skyrocketing to highs in the $14 range in 2020 on pure speculation, the company's shares have cratered to 35 cents. A listener asks us if the shares have any value after its massive drop.
Julia Grosso from Vancouver to win it for Canada! Canada came! Canada conquered! Canada gold at Tokyo 2020!
Okay, we're probably not supposed to play that on here, but I don't really care because that was an awesome moment for Canada. Now, first off, my number one sport is hockey, but this past Friday morning, I was a massive fan of Canada's women's soccer team. I coach my 6-year-old daughter's soccer team, and I had the family up to watch it, and that was an absolute roller coaster of emotions. The game itself, going down 1-0 to start, battling back on the VAR, video assisted replay call. Jessie Fleming delivering literally with cold precision. It was 400 degrees out, but somehow she had ice in her veins and, puts the penalty kick in. Then to go up, 1-0 in penalty kicks and miss 3 in a row. Canada missed 3 in a row, and then Sweden has 2 chances to win it. And their veteran captain is on the line, and she skies the ball the first effort, completely missing the net. Then Deanne Rose has to stand up, and she absolutely, with an unstoppable effort, top right-hand corner, the shootout is sent to sudden death. And the Canadian goaltender, who is just awesome the whole tournament, Stephanie Labbé, she is enjoying the moment, all this pressure seemingly. And makes a great save. And then we get the 20-year-old, from our area here, the Vancouver area, Julia Grosso. She makes no mistake, and Canada wins gold. It was absolutely unbelievable. It was awesome. Brennan watched none of it. Did you? Brennan?
I didn't.
I'm going to welcome my co-host.
Yes.
You've seen the highlights now.
I saw the highlights, yes, but it was a little too early for me. I was still in a deep slumber. And to be completely honest, speed walking and the steeplechase are kind of, my sports rather than soccer. So
we talked about those being the absolute biggest drawing events at the Olympics for sure. But I got to tell you, I've been watching this Canadian women's, several iterations of it, their soccer program now. I think, like, I go back to 2002, FIFA's under 18 women's championship. It was hosted by Canada, and I remember watching it, and like literally that's like Grosso, who scored the winning goal, was 1 year old at that time. So this game was a big deal. And you go back to that tournament when I think Canada got in the finals against the US, lost 1-0. It was held in Canada. It was at Commonwealth Stadium in Edmonton. Any of our clients who are or listeners who are in the Edmonton area, maybe you remember. Christine Sinclair was amazing in that tournament. And I think it took 20 years it literally took 20 years for Canada to finally beat the US to get to this final and then get to the finals and beat Sweden as underdogs. Honestly, my daughter turned to me and she said that's the first time she's ever seen a tear in my eye, right? So it was really cool. It was awesome to watch. I mean, I thought the Olympics, while the starting time sucked and there are no fans, but in the stadiums, which made it weird, but like watching Damian Warner win a decathlon, like the first or only the fourth man ever to get 9,000 points, Andre DeGrasse, like literally DeGrasse, and anytime he stands up in a race, gets into a final in the Olympics, he literally medals every time, or Canada medals every time. It's just amazing to watch. So congratulations, Canada, is what I would say. I know this is a podcast about stocks and finance, but I think it was a pretty cool games for Canada overall. So I think we should acknowledge that here today. And Brennan, you were watching the walking,
yeah,
right?
Race walking and steeplechase, but in
amazing.
seriousness, I was watching golf.
What the hell is the steeplechase? Can we?
Yeah, no, that's a good question.
Get into that.
And to be honest, I didn't know about it until Ryan kind of educated me.
I brought it up to you.
Anyways, let's.
I think that you still have chance. You're what, 12, 13 years old? You have a chance to still get into the steeplechase. I mean, there's 7 or 8 athletes in the world. Yep. You could at least finish 8th in it, which would be respectable at the Olympics. And
I like jumping in puddles, so yep, definitely.
Yeah, I could see you doing that.
Yeah.
Anyways, so many of you may have noticed, I guess, or I don't know. I haven't even mentioned that Aaron isn't here today, but I don't even think anybody cares. Does anybody even care if he's not here? Like, I think last week's show with just him there, and I think you were there. I'm not sure, Brennan. I didn't.
Wow.
I didn't really notice, but I think this was the lowest rated show of all time. So I'm back here to try to bring our ratings up once again, and I'm really confident that we can do that. Did you want to get into anything before the companies?
The only thing that I'd like to say is that I did write a nice article called "The Greatest Lesson Charlie Munger Taught Warren Buffett," and this was actually
it is a good article. It's posted on our website.
Newsletters. Yes, it's posted on our website on the blog. It's just kind of interesting going into how Warren's investing strategy was when he was younger, and then also Charlie's investing strategy and how they're different, and then how they kind of came together and I guess utilize both strategies together with Berkshire Hathaway. Anyways, it's a good. I enjoyed writing the article. I think it's a good piece, and as well. The reason I wrote this is essentially I was actually sick over August long weekend, and I ended up watching Warren Buffett's documentary. I guess it's a 2017 HBO documentary, and you can watch it on YouTube for free. And if you go to the article on our website, you can get linked to that documentary for free, and you can watch it if you're interested. I really recommend it to any clients because realistically, it just has the solid investing principles that Keystone tries to portray for clients and just for investing in general. So yeah, it's a good read and a good watch. So that is all I would like to say beforehand before we get into the
I mean that's what a true analyst does when they're sick. Instead of watching some of the Olympics or watching like I don't know, a movie from the MCU movies, all the Marvel movies, you watch a documentary on Warren Buffett. That shows your absolute dedication right there.
Honestly, that is the truth.
Or it shows something about you. I'm not really sure what it shows.
But it's the truth. No, I literally I watched the Warren Buffett documentary and I look at stock charts and look through CDAR. Honestly, I'm a stock nerd, but I love it. It's there's nothing boring about investing in good companies and making money, of course.
Yeah, and we're going to get into a few companies this week, a couple of them decent companies that we're going to get into. And we will welcome Aaron back next week. I believe he'll be on the show again, so all his fans can welcome him back. Aaron's grandma will be definitely happy that he is back next week, is what I'm trying to say. Right?
I guess so.
Okay.
So.
Now let's get into our first Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. The first one is on WELL Health Technologies Corporation. Came in from a listener, WELL on the TSX. It's about $7.50 in that range, $1.6 billion market cap. What does WELL Health do? Well, WELL is an omnichannel digital health company focused on empowering doctors to provide the best and most advanced care possible while leveraging the latest trends in digital health. Now, clients will know WELL Health as the company that acquired a past recommendation, CRH Medical, and helped us turn a profit on that investment. Now, though stock has pulled back of late, it has performed tremendously well over the past 3 years and has a skilled capital allocation team at the helm who have grown businesses and exited at a significant profit in the past. So that is a plus for the business. Recent acquisitions. WELL recently acquired MyHealth's 48 clinics across Ontario and now became the largest owner-operator of outpatient medical clinics in Canada with 74 in total. Now, I would expect that number would continue to grow given that both WELL and MyHealth have active M&A strategies, with MyHealth in particular having an active pipeline of over 125 targets. We are assuming those are clinics. Now, CRH Medical further augments a strong M&A pipeline and picture, and CRH has been acquisitive over time as well. To fund further acquisitions, WELL should have access to over $300 million in capital, including capital from the closing of a $200 million senior credit facilities and some other credit financing used to help fund the MyHealth acquisition. So good growth outlook, but let's look at the valuations. WELL's EV to 2021 expected EBITDA is in the range of 30 times, which is high. This drops to about 17.5 if we look at the 2022 expected EBITDA. So it's more attractive based on that. Now, while I do not love using, and I hardly ever use, enterprise value to revenue metric, because many of WELL's peers are light on profitability or even EBITDA in terms of comparison, we can take a quick look at WELL from this perspective. WELL is trading about 4.2 times EV to revenue on 2022 revenue expected, which is slightly above its primary care or omnichannel peers. It's about 3.6 times, which they are trading at. So it's 4.2 versus 3.6. It is at a significant discount to its telehealth peers, which are about 7.5 times 2022 expected EV to revenue multiple, and a discount to to healthcare technology peers at 10.9, so a significant discount. But it is a premium to the average healthcare services peers, which are at 1.8 times. So it's a lot of numbers to throw out there, but WELL does not fit perfectly into any of these boxes given the fact that it is a mix of telehealth and traditional clinics, but its valuations is not off the charts when we look at these, and some would argue it still has room to grow. But we are seeing a contraction in valuations in the sector generally after sky-high multiples earlier this year. So conclusion for us. For share price growth to continue, long-term management will have to continue to execute, skillfully walking the line between dilution and creating cash flow on a per-share basis. It can be a difficult path to chart, but WELL has a team that has done it in the past. We see the company as an intriguing bet on management longer term. Growth will have to continue if it can. WELL may be an option. We monitor it closely and we expect it to be volatile.
Perfect. Good analysis. And yeah, just, building off of that, I've touted it many times. There's another company that I really like under our Canadian small cap coverage. That's, a healthcare services provider essentially. Trading at a lot better valuations, great growth. Anyways, obviously, I'm not going to say the name right now, but another company that we can potentially anticipate to feature on the podcast is a company called Nova Leap Health Corp, NLH.
And
on
that's
the
not
TSX
the company
Venture.
that you're referring
No,
to that's in our
no,
coverage.
good.
Let's just
Thank
make
you.
that
Yes,
crystal
thank you
clear.
for making that crystal
no
clear.
worries, no worries.
But no, that's good that you say
I
that.
anticipate a bunch of emails. Oh my God, which company?
Yes, that's the company. That's the company. But no, so that is, I just wanted to say that is another health company that we are going to take a look at that actually came in from one of our Canadian small cap subscribers. And he
Yeah, and it's
wanted
an
us to
interesting
compare
name
it
as well.
To, that other name that I was touting. But yeah, so we'll take a look at that one as well on a future episode. As he even says here, it was ranked the second fastest growing company in 2020 in Canada. But realistically, it really all comes down to the numbers, comes down to the valuation. We really need to take a peek. But just wanted to allow listeners to know that that's coming up in the future.
A little teaser for what we have in store
You bet.
coming up. When Aaron's back, maybe we'll throw that Aaron's way. But I have a feeling you'll probably want to take a look at that company.
I kind of want to take it, yeah.
Yeah, just steal it from Aaron. He does.
Yeah, it's mine.
He's not here. Doesn't matter. Okay, now our second Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Came in from a listener on Tree Island Steel, TSL and TSX. Brennan, that's yours.
Thank you. So yes, Tree Island Steel, TSL on the TSX, currently trading at a price of about $4.07 and has a market cap of $116 million and a dividend yield of about 2.5%. So Tree Island Steel operates in the steel business and is primarily engaged in the manufacturing and sale of steel wire and related products for a range of applications. Just to go over some of these products, they include bulk nails, stucco reinforcement products, concrete reinforcing mesh, fencing, and other fabricated wire products. So some key points here is the company announced a one-time special cash dividend of 5 cents per share payable on October 15th of 2021, as well as this special dividend is in addition to the company's regular quarterly cash dividend of 3 cents per share that is also scheduled to be paid on October 15th of 2021. I don't know exactly when that ex-dividend date was, but any current shareholders, I believe right now, can anticipate that coming in the future. And looking at the company's recent financial results for Q2 of 2021, there was some good revenue growth that increased about 47% to $74.4 million compared to the same period last year. And this growth was due to higher demand with the economy reopening and because of increased selling prices across all market segments with the increase of steel prices. Now, net income for the quarter also increased substantially from last year to approximately $9.1 million, and adjusted EBITDA grew over 260% to $14.7 million from $4 million for the same period last year. And management indicated that both the increase in adjusted EBITDA and net income was influenced by the elevated pricing along with ongoing inventory and cost management across the business. But they said as the steel supply chain rebuilds, inventory and availability of product improves, we anticipate more balanced market conditions in the future. So my question here is, does this mean that the elevated profitability is sort of one-off, or will it be ongoing for some time into the future? And realistically, it would be good to interview management to get a better feel for the sustainability of this profit going forward. Now, looking at the balance sheet, they have net debt of about $74 million and a net debt to EBITDA multiple of 2.6 times. So getting up there, but not too bad. And a valuation of an EV to EBITDA multiple of 6.6 times, which I would say is reasonable in my opinion and possibly trading near or under fair value. That is, if growth like this can continue. Now, one point that I do want to make here is that revenue really has been kind of flat and sort of lumpy realistically over the past 8 quarters, except for these last 2 quarters where we kind of have been seeing the economy open up. So just bear with me. I'm just going to run over the revenue over these last 8 quarters. So we went from $49.7 million to $45 million to about $58 million, back down to $50.5 million. Then we went to 53 million, 54 million, about 67 million, and then back up to 74 million. So you can kind of see that realistically, except for the last 2 quarters, realistically revenue has just kind of stayed around that 50 to 55, 57 million mark. So there really hasn't been sustained growth going forward, which is kind of a concern. And, something that we'd want to ask management about is if, this revenue growth will continue, or if this is just essentially from pent-up demand. That's a big question that we'd have. So to conclude, Tree Island Steel appears reasonably attractive. Although lumpy, the company has been growing revenue and profitability, has a decent yield, reasonable valuation, and a reasonably healthy balance sheet. But like I said before, what one must keep in mind here is that we have two forces at play. The first is increasing demand from the economy reopening. And the second is the increase in steel prices, which are up over 200% from the same period last year. And this increase in steel prices is essentially what has helped the company increase its profitability margins substantially. Now, generally speaking, if someone thought that the price of steel was going to continue to increase, I think that it could be a decent option to gain exposure to this underlying trade or investment thesis. But long term, there is definitely some uncertainty, such as if steel prices turn and demand for steel begins to slow in the economy, we will see the opposite effect happen with revenue and margins declining and subsequently the stock performing poorly. So realistically, it's a tough call. Fundamentally, the business is performing well as of recent, but some speculative aspects really keep us hesitant from recommending the business to our clients.
Yeah, I think it's a good summary. And I guess, and you talked about this, as far as going forward, is it an investment right now? We have to look at what has changed in the last couple of quarters to increase revenue growth and profitability. If the growth and profitability increase is sustainable, or whether it's just a near-term bump. If it is sustainable, Tree Island probably looks great. If it is a near-term bump due to steel price increases or pent-up demand, and we don't expect steel prices, they're not likely to continue growing at the pace they did over the past year, for example. But if we don't see that, then you're caught in a situation where this may be a company where nothing really has changed in the business other than those two factors that are really outside of their control, and they may be one time in nature. And then you've got a company that looks great, cyclical company that looks great financially, which is typically the worst time to be invested in a company like that. So that is the issue when you've got commodities and one-time events impacting a stock price. You've got to definitely, like you said, I think it's 6 point something times EV, EBITDA.
6.5 about.
6. Yeah, 6.5 in that range. If it continues to grow at 30-40%, that's looks like a screaming buy. Historically, it hasn't, so we would expect that profitability to be more one-time in nature, and that's why we would be more cautious on it over looking 2 to 3 years out. And it's prudent to be cautious on these businesses that have exposure to commodity prices or pent-up demand during like this one-time slowdown type event, and then some pent-up demand that comes in. So, and I think management themselves is
exactly. And if I could even reiterate that, this is pulled right from the management's MD&A. They say, but as the steel supply chain rebuilds, inventory and availability of product improves, we anticipate more balanced market conditions in the future. So they're kind of leading into what we're kind of expecting almost as well.
So if you see a normalization, even a pullback in growth, like if you see a quarter where there's revenues decline and profitability declines, the share price inevitably will get hit probably significantly. And that's why while current numbers look good, the question is, are they sustainable going forward? And that's the question we always have to look at in a business like this, because it can be highly fluctuative and sensitive to commodity prices and pent-up demand and all those things. So that's why, while it looks cheap, it may be a value trap. Certainly. Okay, now let's get to is there anything else you needed to add on Tree Island?
Thank you for your comments.
We're going to look at our dog of the week, and I noticed you put dog of the week /month/year. This is a company that we have mentioned a couple of times, and because we've got questions on it from listeners, and both times we resoundingly said we wouldn't basically touch it with a 10-foot pole. And I think you'll reiterate, we got some flack from some people who were real, believers in the story long term. But we're just looking at the numbers and from experience, looking at businesses like this who glom onto, the flavor of the day or the hot topic of the day. And, that seems to be the case here. But you can go through the whole story right now.
From our Stars and Dogs segment, it's time for this week's Dog.
Certainly. So this is Sona Nanotech Inc, SONA on the CSE, currently trading at a price of about 35 cents and a market cap of 22 million. Now, Sona Nanotech is in the life sciences industry with the primary objective to develop and produce its own lateral flow rapid COVID-19 antigen tests utilizing its gold nanotechnology, which is supposed to increase performance and reduce the time to market. Now, as Ryan said, this is actually the third time that we've covered Sona on the podcast now. The first time was in mid-2020 when the stock traded around $2.50. And then later in December of 2020 when the stock soared to highs of $16 and then had retraced back to just $1 per share. So that's when we recovered it, essentially. So both times we covered the stock, we highlighted it as highly speculative and not a company with investment merit. And like Ryan said again, following these statements, we did get quite a bit of criticism online with people saying we didn't understand the technology and how it was going to be revolutionary. You know, and what I would say to those people who made these comments is that they were right in the fact that we are financial analysts, not scientists. So we cannot pretend to understand the technology that was supposed to be groundbreaking and come to the conclusion that its test would pass approval and be revolutionary for fighting COVID-19, which was why we erred on the side of caution, considering the company had yet to produce any revenue and traded with a market cap of over $100 million at the time we had it on the podcast. So looking at a few key points here, which recently made it a dog again. On June 11th, 2021, the company announced it was discontinuing its previously announced clinical trial of its COVID-19 rapid antigen saliva test due to inadequate test sensitivity with clinical saliva samples. So obviously this was horrible news. The stock, I believe, went from about $1.20 right down to about 30 cents that day on that news. Now, David Regan, CEO of Sona Nanotech, said, "We are surprised that our clinical trial did not show a corresponding level of sensitivity to our laboratory studies, which showed that our saliva test was able to detect gamma irradiated COVID-19 virus at clinically relevant levels." Furthermore, he said, "We look forward to continuing further bold pursuits in new applications that leverage both our proprietary gold nanorod technology and the considerable base of experience afforded to us by our COVID-19 test development program." So you can see him kind of spinning it here where it's, he's saying that, our COVID-19 test development program didn't work that well. But we gained great experience from it, and now we're going to pivot into new areas. So just to note, some of these tangents for its nanorod technology include point of care diagnostics, drug delivery, photothermal therapy, and cell imaging. But again, we come back to our initial point. We have no idea if Sona's proposed technology will indeed be effective for any of these areas. So quickly looking at the recent financial results for Q2 of 2021, there's still no revenue, of course, and the company had a loss of over $3 million in the last quarter. And the company right now has about $500,000 in net cash, so we could reasonably expect that they will have to issue more shares in the coming quarters to keep the lights on and pursue new potential opportunities, especially because this is a company that has to invest quite heavily in research and development because they don't even have a product to bring to market. So to conclude, I think this is very straightforward. The stock was built completely around the premise that its rapid COVID-19 test would work and be brought to market, leading to Sona, which had no revenue, to trade with a market cap of over $700 million at its peak, which is absolutely outrageous in my opinion. Now, if a trader was able to get a quick flip out of the stock, I would like to congratulate them, but overall, timing on when to get in or out of a stock like this would have been near impossible. It is a very, very difficult thing to do. Now, as our listeners know, we are not traders and want to see a company grow long term. Hundreds of investors placed their money in Sona at elevated prices and were left holding the bag, only to have their initial investment worth essentially nothing. Now, we even had an individual on YouTube ask if there was still hope for the stock to rebound to the pricey levels they had bought in at. But all we could essentially say is that it was far from a stock that we would recommend to clients to hold. And, we still stand by that. The company still doesn't have any revenue. And it just stands as a good, kind of case study, essentially, where you have these high flyers that go from, just cents all the way up to $16 and crash right back down. It's a good thing to keep in mind that can happen with some of these high flyer names.
Yeah, it's a good summary. For me on this company, as you stated, we are not scientists. We don't have a specialty in Sona's particular field. But newsflash, neither are most of the investors that fell in love with their quote unquote technology and just went on what management basically stated. Again, newsflash here, management has a vested interest to say that their technology is great and everything's wonderful with the business. What we did know when we reviewed the company is there was not even a test kit in the market. No proof of concept, nothing even close to revenue, and many competitors well ahead of this company. Pure speculation, it got to a $700 million valuation. That's ridiculous. And the more companies that I would say, generally speaking, that one speculates on with this type of profile, no proof of concept, no revenues, no earnings, just a hope of something in the future, the more money will be lost by that individual over the long term. So I hope this serves as a cautionary tale. That's what we like to show, and that's why we revisit a company like this that has lost investors a considerable amount of money on pure speculation over time. Again, Sona Nanotech is your cautionary tale of a company that, when you invest in companies with that profile, more often than not, you end up in a loss position. Like we say, go on the flip side, look at companies that do have a proof of concept. They have revenues, they have earnings, they have cash flow. They are growing the business and they trade at relatively reasonable valuations. You can find them out there. The more companies you add with that profile of the 15 to 25 that you put in your portfolio, the better chance of success in the stock market, which is a hard area to invest in over the long term. But the more you put in your portfolio with that profile, the better chance you have of success. And again, on the flip side, there's the Sona Nanotechs of the world that serve as good illustrations of the flip side of that equation, the downside risk you have in companies that don't have any of those qualities or don't match up to the qualities that we're looking for in the profile of what would be a good stock to invest in over the long term. So I hope that summarizes it well for the listeners out there. Brennan, do you have anything to add for this week?
No, that is good.
You're good? Okay. We truly, truly missed Aaron. This is this third time, I think, or second time maybe this week, I'm shedding a tear that I didn't have Aaron on the podcast this week. We hope to have him back next week, and it'll be great to have all three of us on. Again, I'd like to thank listeners for sending in their questions for our Your Stock, Our Take segments. If you want a couple companies to look at, pit those two against each other. We will look at that and keep your questions coming in. Ask Us Anything segment as well. Continue to rate us on iTunes. Give us your ratings on there. It helps us pump out some good content on here on a weekly basis. Thank you very much, and I wish you all out there profitable investing.
Thanks, everyone.